Imagine sitting down with Mr. Warren Buffett, the renowned investor, as he shares his wisdom on wealth creation. Now, one of his favorite topics is monopoly. Buffett often emphasizes the importance of finding companies with a moat, which is a protective barrier against competitors. But what does this mean in the context of the Indian stock markets? Well, it's about those rare companies that tower over their industries virtually unchallenged. Now, these are the monopoly companies, the powerhouses of their sectors. Today, we are diving deep into the fascinating world of monopolies. We'll explore what makes a company a monopoly, the different types you will encounter, and most importantly, the monopoly stocks in India, and examine their market dominance and financial prowess. So let's embark on this journey together as we unravel the secrets behind India's monopoly giants. You're watching Informed Investor, the Third Empire, an initiative by Research and Ranking. Let's begin. Let's start by understanding what exactly is a monopoly. Now, a monopoly is a market structure where a single seller or a single manufacturer dominates the supply of a particular good or service. It can dictate price changes and create barriers for competitors to enter into this marketplace. Now, the Indian stock market offers diverse investment opportunities across various sectors. While pure monopolies are rare, some companies hold significant market share and competitive advantages, often referred to as the dominant players or the market leaders as such. Now, let's discuss this in more detail. Now, characteristics of a monopoly. Ideally, under monopoly, there is only one seller selling the product, and thus the monopolist has full control over the supply as well as the price of the product. Now, in the Indian market, the company with the highest market share is usually the market leader. Now, the products that a monopolist produces have no close substitutes. This ensures that the company has no fear of competition from existing or new products as such. Another key feature of a monopoly is strong barriers to entry of new firms and exit of the existing firms. Now, there can be various reasons for such barriers like licensing or patent rights or government restrictions. Now, a company that enjoys monopoly may benefit from bulk purchasing, efficient resource allocation, and specialized machinery, leading to lower per unit costs. Now, this is popularly known as economies of scale. Now, firms and industries are one and the same thing in the case of a monopoly. So the firm has complete control over the industry output. This gives a monopoly the right to fix the prices, hence it's a price maker, so to say. The price can be influenced by changing the supply of the product by the firm. Now, how does a company achieve a monopoly? Well, there are different types of monopoly. Any company with a market share of more than 50 to 55% can be considered as a monopoly in the Indian market. IRCTC and HAL are companies with almost 100% market share. Now, these companies can be categorized as government monopolies. Government creates such monopolies to control a particular industry, often for reasons like public safety or national security. Performance of such companies depends heavily on government's policies and contracts. Next is by brand recognition or goodwill. Now, another factor that helps companies achieve monopoly is goodwill. For example, Colgate and toothpaste are used as synonyms. Similarly, we associate Maggi with noodles, Xerox with a photocopier. Now, this goodwill, built through years of quality products, extensive marketing, and robust distribution networks, fosters customer loyalty and potentially fuels future growth, making them potentially attractive investments. Next is natural monopolies. Now, the dependence on natural resources and infrastructure limitations can also lead to a creation of a monopoly. Such monopolies are termed as natural monopolies. The most common example of natural monopolies are electricity and water services. Such monopolies arise when a single entity controls a critical resource required for an industry. Now, this creates a dominant player with a significant market share and market power as well. Next is vertical monopoly. Vertical monopolies occur when a company controls multiple stages of production or distribution process. Example, Reliance Industries Limited is often cited as an example of a vertical monopoly in India. Reliance Industries has interests in various sectors including petrochemicals, refining, oil and gas exploration, retail and telecommunications, controlling several stages of the supply chain in these industries. Now, let's have a look at the top 10 monopoly stocks in India along with their market share. Now, most of these companies are operating in essential sectors with limited competition. Along with the market share, we've also mentioned the industries in which the companies have a monopoly. Some of them are government monopolies like IRCTC and HAL. Companies like Coal India and Hindustan Zinc are natural monopolies. Now, while we've looked at the top 10 monopoly stocks in India, let's dive deeper into some of these businesses and understand them better. The first, let's talk about IRCTC. When we talk about monopolies in the Indian business landscape, one company that immediately comes to mind is the Indian Railway Catering and Tourism Corporation, or the IRCTC. Let's delve into why IRCTC is often cited as a prime example of monopoly in India. Firstly, let's understand the revenue streams of IRCTC. The company offers 5 major services to the Indian public, namely e-ticketing, packaged drinking water, catering, tourism, and state tirtha. Now, starting with e-ticketing, IRCTC holds the exclusive authorization from the Ministry of Railways to provide online ticket booking services for Indian Railways. Its website irctc.co.in and the mobile app Rail Connect are the go-to platforms for millions of passengers daily. Now, this segment alone contributes to a significant 33% to the company's revenue. Now, moving on to catering services, IRCTC is the largest hospitality and catering company in India, serving passengers on trains and at railway station premises. Now, this segment, inclusive of various ancillary services, accounts for approximately 43% of the total operating revenue of the company. Another area where IRCTC enjoys a monopoly is in the packaged drinking water, handled as Rail Neer. It holds exclusive rights from the Ministry of Railways to manufacture and distribute packaged drinking water at railway stations and trains. Now, state tirtha and tourism also contribute 9% and 6% of the revenues respectively. Now, why does IRCTC's monopoly matter? Well, in essential services like the railways, customers often have limited or absolutely no alternatives. Now, this lack of competition gives monopolies like IRCTC the power to maintain stable earnings and cash flows. However, it's essential to note that monopolies aren't immune to economic downturns. The COVID-19 pandemic significantly impacted IRCTC's revenues and margins, highlighting its vulnerability against such crises. Now, IRCTC's Achilles heel lies in its monopoly status. While it's currently a great business model, any regulatory changes could interrupt its operations. Now, if the government were to introduce competition in the sectors where IRCTC operates, it could hinder its growth potential. For retail investors interested in IRCTC, it's crucial to keep an eye on regulatory shifts. These changes could be pivotal in determining the company's ability to sustain as a monopoly and consequently its long-term prospects. Next monopoly that we are going to discuss is Hindustan Aeronautics Limited. This is another significant monopoly stock in India. The company plays a major role in the entire defense sector. Currently, HAL is majorly owned by the government and is involved in the design, fabrication and assembly of airplanes, jet engines, helicopters and other components. Now, the company has stable revenue, growing operating margins and a strong ROCE margin. HAL also maintains a healthy dividend payout of 31%. Now, in the last year, the stock offered a return of 166%, and over the last 5 years, the company delivered returns of upwards of 900%. Next up in line is Coal India Limited, which is a behemoth to the Indian energy landscape. Now, imagine a company controlling over 80% of the country's coal production, holding the key to powering several industries like power, steel, cement, fertilizers, brick kilns, and well, mostly everything else. That's CIL, a public sector undertaking with a long and complex history. But this dominance comes with a question mark. Is it necessarily a monopoly or an outdated one hindering progress? Now, established in 1973 under the Coal Mines Nationalization Act, Coal India Limited enjoyed a near absolute monopoly for decades. Now, this meant they controlled everything from mining to selling coal, influencing prices and impacting millions in the country. Now, in terms of Coal India, their coal and coal-based products are essential for sectors such as steel making, fertilizers, glass, power utilities, cement, ceramics, chemicals, paper, domestic fuel, and industrial plants. However, in 2020, the Indian government announced the end of Coal India Limited's monopoly by a Supreme Court ruling. Now, despite its status as a public sector undertaking, and accused it of abusing its dominant power in the production and delivery of non-coking coal, thereby allowing private players to mine and sell coal. Now, this was a watershed moment driven by the desire to boost competition, attract investments, and modernize the coal sector. But while private players are entering, Coal India Limited remains the dominant force, being the largest pure play coal producer in the world. Now, the transition is happening gradually with challenges like land acquisitions and regulatory hurdles slowing things down. An interesting factor now is approximately 7.6% of India's total power generation is managed through the thermal route, and 84% of the total coal production in the country is supplied to the power sector. Coal India Limited is the largest supplier of thermal coal to the power sector, and hence power security in India is directly dependent on Coal India Limited's performance. And since it is a PSU, the President of India through the Ministry of Commerce and Government of India holds a majority of 63.13% of the shares, while the remaining 33.87% of the shares is divided between FIIs, DIIs, and retail investors. Anyway, let's get into the financials of Coal India and understand how this monopoly status impacts its financials. Being the largest coal producer, its recorded revenues of 1.38 lakh crores in FY23, growing at a CAGR of 6.05% over the last decade. Now, the operating profit margins have been healthy around the average 20% mark, with the latest reading in FY23 of 25%. When looked at the bottom line, its net profit grew around 28,000 crores and grew at a CAGR of 6%. Moreover, in FY23, it reported its highest ever coal production of a massive 702 million tons, an increase of 13% from the previous year. Now, for shareholders, as you can see in the chart, it has maximized shareholder value and returns by providing a dividend payout of 53%, which implies that the company has channeled 53% of the earnings as dividends and has a trend of regularly rewarding shareholders via dividends. Now, in fact, since the IPO of Coal India Limited, it has paid more than 1.49 lakh crores of dividends. Now, in terms of the returns, Coal India has delivered over 100% returns in the past 1 year and currently trades at its all-time highs. To conclude, while there is an evident shift towards renewable energy sources, coal will continue to be the dominant source in our country's fuel mix, as it offers reliability and stability of supply at affordable prices. Now, despite the entry of private companies post-2020, new entrants face challenges obtaining licenses and navigating complex regulations. Now, the last stock that we will discuss about is ITC, which has been a favorite on social media courtesy of all the memes surrounding it, and it recently surprised us all with a significant rally between the 11th Indian company to cross the massive $5 trillion rupee market cap. Now, established in 1910, ITC or Imperial Tobacco Company is India's largest cigarette manufacturer and seller in the country. After being solely into the cigarettes business for 6 decades, it finally decided to foray into other territories. As of today, ITC operates in 5 segments and is recently concluded the Q3 of FY24. A major chunk of the revenue, about 40%, comes from the sale of cigarettes, followed by FMCG at 27.8%, which includes its flagship brands such as Ashirwad, Bingo, etc. At 16.3% comes the agri business, followed by the paper and packaging segment at 11.1%. ITC Hotels comes in with the least contribution to the revenue at around 4.5%. But ITC stays true to its name and commands a market share of about 75% in the cigarette business. Now, this dominance, however, comes with complex dynamics surrounding government regulations, competition, and ethical considerations. Now, interestingly, India happens to be the world's second largest consumer of tobacco, and taxes on cigarettes remain one of the highest compared to the other nations, as you can see in the chart. Now, taxes on cigarettes in India are multiple times higher than in developed countries, which is 17 times of USA, 10 times of Japan, 7 times of Germany, and so on. Now, moving on to the financials, ITC reported revenues of 31,267 crores in FY23 from the cigarette segment alone, a growth of 20% from the previous year. Now, what's more interesting is that the cigarette segment maintains EBIT margins of around 60%, showing the significance of this business. However, in the recent Q3 results of FY24, a concern was noticed on the volume growth of the cigarettes business, showing a decline by 1%. There are two main reasons for this. Firstly, as the third quarter is close to the announcement of the union budget, dealers usually stock up in anticipation of any adverse revision in the excise duties. Now, with this year being an interim budget and not a full-fledged budget, the usual stockings has not taken place yet, leading to the decline in the volume growth. Now, the second is the higher base effect. Now, the base quarter, which is the December quarter of financial year 2022-2023, saw the cigarette business report volume growth at 15%. But overall, since it maintains high margins and strong cash flows, it allows ITC to reinvest the profits from the cigarette business and build the infrastructure for other segments and verticals of ITC. In terms of returns, ITC delivered 10% returns in the past year and around 50% returns in the last 5 years. Overall, ITC has been a great defensive stock driven by the strong cash flows of cigarette segment, high margins and attractive dividends, overall making it an attractive company in terms of fundamentals, allowing it to complement and offset their verticals across ITC. But it's not all rain and sunshine. The cigarette segment is subject to government interferences in terms of tax hikes and stricter regulations, followed by awareness of health concerns facing criticism for promoting tobacco consumption. Now, to conclude, investing in monopoly stocks can indeed present enticing opportunities, but it's crucial to weigh the potential benefits against the inherent risks. Here's a breakdown of why investing in monopoly stocks can be appealing, along with the associated risks that you need to watch out for. Talking about the advantages, market dominance stability. Monopoly stocks hold a dominant position within their industries, providing stability in their market presence. This stability can translate into consistent revenue stream and earnings over time, offering investors a sense of security. And the control over pricing. With limited or no competition, monopoly companies have significant control over pricing. This pricing power allows them to maintain healthy profit margins even during economic downturns, which can be appealing to investors seeking resilience in their investments. Reliable dividend income. Monopoly stocks often generate substantial cash flows due to their stronghold in the market. As a result, they tend to distribute regular dividends to shareholders, making them attractive for income-seeking investors who value consistent income streams. Long-term growth potential. Monopoly firms are well positioned to capitalize on long-term growth opportunities within their industries. Their dominance allows them to explore new markets, expand their product or service offerings, and invest in innovative with fewer competitive pressures. Talking about the risks, regulatory uncertainty. Monopoly companies are subject to regulatory oversight, and changes in regulations can significantly impact their operations and profitability. Investors must carefully monitor regulatory developments and assess the potential implications for their investments. Innovation stagnation. Without competition driving innovation, monopoly companies may become complacent and fail to invest adequately in research and development. Now, this lack of innovation can impede long-term growth prospects and leave them vulnerable to disruption from more agile competitors. Industry vulnerability. Monopoly stocks are heavily dependent on the performance of their respective industries. Now, any disruption or decline in the industry, whether due to technological advancements or shifts in consumer preferences, can adversely affect the performance of monopoly stocks. Limited growth potential. Because of their already significant market share, the room for explosive growth might be limited compared to smaller, more nimble competitors. With that, this is Raj Mehta signing off from today's episode, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.